All right, here we are. Okay, so I'm going to start this presentation with a cartoon. Everyone knows the story about Lucy pulling the ball from Charlie Brown and he ends up on his back. And that reminds me a lot of how the stock market, everyone gets excited that we're going to break out of this downtrend. We're going to have some great news from the Fed that they're not raising interest rates anymore. And as soon as we have a Fed meeting, we end up going back down to a lower low. So that looks like what's happening right now. We're just still in this downtrend, and it's worked all year long for the major averages. And until the Fed stops raising interest rates, we're gonna follow that path. So that being said, let's look at what happened this week. This week we had a Fed meeting, and the Fed basically gave a statement that said we're going to raise longer and more than expected, and that was what caused the stock market to go down that day. And so basically we're looking at our calendar. We were hoping that the Fed, this will be the last time that they raise the interest rates, but it looks like it's going to drag the whole way out, possibly into February, because they said, well, we're not even close to coming to a point where we're going to stop raising interest rates. So the interesting thing about our calendar here is the Fed meets in December 14th, and they don't meet again until February. So we have this whole swath of time where everyone's wondering what's going to go on. Are we going to raise more? And that's why I listed basically all December and January as like we're not sure what's going to happen. But I think the consensus, all of our charts show us that when the Fed is accommodative, when they're lowering the interest rates, the stock market is juiced. Whenever they're taking money away, the stock market doesn't have that much momentum around it. So that statement on November 2nd was really big. I mean, it changed the whole calculus of how we're. Any comments about that?
Well, I read some comment from some of experts out there. They didn't say that the Fed will stop. They just say the Fed will slow down, and that's exactly what the Fed did. They keep the increase rate now, but they said that they will get a multiple smaller increase later. So that's the slowdown.
Right.
Don't know why is expectation of stop. They know stop. They will just slow down.
Right. So they so that's why we had a 75 increase in the interest rates, and people are saying that there's going to be 50. So it's going down in that sense. So everyone's expecting 50 for the next meeting, maybe 25 for this last meeting. So until all that's done, the stock market is in it's going to be like super flustered and going down, perhaps. We do have these seasonal patterns where we have Thanksgiving, Christmas coming up, and usually stock market's good before those. But right now we have an interesting, another interesting thing happening, which is there's a lot of losses this year. This is probably one of the first times we had tax loss harvesting for the average user. Like this is retail investors. It's not mutual funds. It's retail investors that might have to sell some of the stocks that performed the worst this year. So you have an extra amount of people, some say that people have already sold. If they sold, they probably already sold into this time right now, but there is that tax loss harvesting that could be going on, which which is why we have like a yellow throughout December now. All right, so that's the big picture. Let's look at what's going on in our meeting notes. Two bad things for the stock market. The 10-year is up 3%. 2-year is up 7%. in the 2-year, we know the Fed follows this rate for their interest rate increases. So we don't want that to go up, but it is because of the statement that the Fed made on Tuesday. This reacted to that. So we're still at the Fed reducing its balance sheet. This is all pretty much negative for the market. So I'm going over our catalyst for the market to go up and go down because we have several things that happened this week that that helped and hurt the cause. So the definite Fed statements, no, that was not the case. They made it more confusing. Federal Reserve said that it was far too soon to be talking about a pause in interest rate hikes. That means in our calendar, far too soon. Everyone was expecting here, maybe we'll have another 25 basis points there. That's what kind of that means. So you see, so basically for our stochastics, we're looking, we're still following, we're overbought right now still. We're like 77. So we're still following the pattern of lower highs, lower lows until the Fed is done raising interest rates. We don't have any catalyst right now to get us out of that. So you see, so some catalysts for stock market going up. If the 2-year, 10-year Treasury goes down, that's good, but it didn't. It went up. The good earnings announcements. We had mixed earnings this week. We had some good earnings from Starbucks, eBay, but a lot of the tech stocks are basically the old leaders of the market. They were getting crushed this week, the big tech stocks. So the earnings aren't helping a whole lot. Now, other things, the dollar is pretty much the same as last week. It didn't go down a whole lot. We're still overbought in the market. And China, there was some indications that the COVID lockdown might be ending in China, and that might be a catalyst for the stock market improving. But China pushed back on that and said it's rethinking. It's not rethinking its zero COVID policy. We have another thing that the market might go down on is tax loss harvesting. I just mentioned. So at the end of the year, tax loss harvesting is if you made a gain, let's say in a stock sell, $30,000, and if you lose $30,000 somewhere else, you could sell that stock that lost money, and you'd break even for the year. You won't owe any taxes. That's what tax loss harvesting is. Not only is something for non-retirement accounts, regular accounts. All right, so in this company doing
quick question on tax loss harvesting. I know about the gain, but the loss, there's a maximum you can claim on a loss, right? Like 80%. You cannot claim loss on the whole thing. Like if you gain 1,000 on a stock and you lose 1,000, you cannot claim that 1,000 into the gain because there's a maximum percentage, right?
Okay, let's give an example. Let's say this year made 100,000 in Microsoft sale, lost 200,000 in Adobe sale. Okay, so you have 100,000 in that you lost when you net everything out, right? So that's your total loss for the year. Now, in normal tax returns, you can only take out 3,000 for losses per year.
Right.
but you can carry over 97 for next year. It's called a carry over loss.
Yeah,
You
that
can
would last you
apply to
for
next
another
year.
10 years, right?
Yeah, you can. No, it's unlimited. You can carry that over an unlimited number of years until
next year you can have a maximum of $3,000
yes.
allowed.
So next year, if you do no trades at all, you can take $3,000 off what you owe your tax bill is. For instance, if you make $100,000 a year, and then you have $3,000 in carry over in losses, then you pay taxes on $97,000, right?
Yep, I know about the calculation.
Okay.
I just want to verify that it's only maximum of 3,000 allowed per year.
Yeah.
That's all.
Yeah. So this three that the carryover is pretty important. You get that, you get that right every year, because that'll be useful in the times when you're actually making money and when you're actually harvesting money, and then you'll have this loss from a prior year, and then you won't pay any taxes, if you had a $97,000 gain in the future. So that's called tax loss harvesting, and they're saying this is the best year ever for that, for maybe since 2008, because there's a lot of widely held stocks that are down. All right, so any other questions about this? All right, so this pattern of what stocks doing great that do great in this environment, the stocks that are continuing an uptrend. Let's look at our stochastics. The stocks that are doing good. We'll avoid all these sectors that are going down. Look, concentrate on the healthcare sector. It's like in the trading range, and we have consumer staples. Pay a dividend, and they have pricing power. And you have utilities who pay a high dividend and pretty consistent over time, regardless of the economy. And you have energy. Energy is actually, it only makes up around 2 to 5% of the S&P 500. It has a low PE ratio, and it's been a neglected sector for a long time. It is at the mercy of price of oil and the price of alternative energy sources, but it's still one of the only sectors in an uptrend right now. So this is like probably one of the 2 or 3 momentum sectors right now. Healthcare is the other one. Healthcare is. Let's look at healthcare again. Healthcare. Okay, this is sideways. Okay, so let's look at the stocks that are doing good to doing sideways. So most of the dividend-paying stocks are still going sideways. Like AbbVie has a 5% dividend, and a lot of the other drug stocks are in the same pattern. Abbott Laboratories, they're going down in it, but most of the other drug stocks we're watching are kind of sideways to up. You can see that most of the tech stocks in the past week or so just got crushed. You can see how Google was at the top of its trading range. Now it's basically at the bottom. Most of the big tech stocks are basically at the bottom of their channels. So until something changes in a major way, we're still in a downward pattern. And even though the earnings are pretty much consistent, the earnings estimates for these stocks, they're still trading with the market. And with them underperforming so much the rest of the market, there's going to be the tax loss harvesting issue with the major tech stocks. So you can see of the 4 major tech stocks, Apple is actually performing and holding up twice as good. So it's down 15%, and Google and Amazon, Facebook are down a lot more, like 30% or more. And let's look at Altria. Okay, Altria is in a sideways pattern. Amazon, you can see it's at the bottom of its trading range. So very good likely indication it'll go up to here and then it'll go back down to here until the Fed's done raising their interest rates. Okay, Apple, you can see that, it's pretty much trading sideways in a sideways pattern right now. It's very close at the end of today. It'll probably be at the bottom of its range. And so it had great earnings, and it's basically, there's a lot of companies like Qualcomm that had bad earnings this week, and they're a major supplier of Apple, and they said demand was slacking in the handset. So there's a canary in the coal mine that there's a lack of demand for handset and mobile phone circuitry. So, but what Apple says about this, you can't just sell Apple on that news, because Tim Cook says they change their suppliers all the time. So even though one of these Taiwanese companies says they have less orders for iPhone, that doesn't mean that Apple hasn't already figured out another supplier that counteracts that story. So, so every one of the tech stocks is basically at a major level of support right now, and it's oversold. So you can see Amazon's oversold, and Google's oversold, super oversold. And let me see. Let's look at. Okay. Yes.
Do you have any? Do you see any fundamental problem with some of your tech company like Amazon versus, say, Google? Aside from the interest rate.
Okay, I actually looked. I'm keeping an eye on Google, and I did a couple deep dives in that today. Let's look at the. Okay. Okay, here's what I did for Google. Just, I was looking at Twitter, looking what some other people were saying about Google. It was trading at $75 before COVID. They had 161 billion in revenues. They basically doubled their revenues, doubled their net income. They have less shares, and right now Google is 85, and after all that, so they're still a strong company. I did the earnings estimates. I don't know how often this is updated. This is from E-Trade. I noticed the numbers are changing, but they're not changing in a major way. So you can see that they're still growing around 15% a year, and their PE is around 15. If you back out the cash, it's like 12 or 13. So it's still fairly valued, and the numbers really haven't changed for the earnings estimates. So we'll have to keep watching this screen every week just to see if there's any major changes. So let me see. So here's the common thread for all the big tech going down this week. There's heavy spending. That scares investors. So Meta, we know, is spending on the metaverse. It basically spent all of its free cash flow on the metaverse. That's a huge bet, and people are real scared of that. We know Amazon is aggressively spending to send things overnight, and they're expanding their warehouses, and so they've gotten away with that for a really long time, and now they got to cut back, and people are scared of that kind of spending. You see, Google, they're kind of cutting back on the nice things they give their employees, but and of course, every one of the companies are cutting back on hiring people. But and Apple, they're reducing their workforce too a little bit. So heavy spending is the first thing that scares people, and there's a pressure on advertising. Every one of the companies, the big tech companies, have a hand in advertising. So as the economy goes into a recession, if we do, there's less. That's the first discretionary expense by companies is advertising. It's easy to pull back on that and instead of firing people and retraining people, etc. So let me see. And the second thing that is in common with all these companies is that the customers, people are unsure what the customer is going to be spending in the holiday season, and that's coming up. The other common threads, margin compression, means that they make less profit, and their PE compression. So Microsoft had a PE of like 30 at the beginning of the year. I forgot to put Microsoft in there. And now it's down to like 25. And similarly, you had Amazon with a PE of 60. We were talking about this before, how expensive that was. Now it's down to maybe 30. So that's called PE compression. And Apple is one of the ones that it's only growing at 7%, but it's trading at 25 PE. So it's still super, overvalued compared to its growth rate. So it has a ways before it's, I guess you can say, fairly valued. Any questions on that? All right. So this week it seemed to be, a big sell-off on the big tech stocks and rotation into like Dow stocks and more conservative stocks. So that's what it seemed like this week. Let's look at some comments that I saw on TV. This one person, Josh Brown, I admire him a lot. He kind of thinks in the GARP mentality, like a growth at a reasonable price. He says, don't expect this to be a hot stock right now, but Alphabet is insanely cheap. He says, analysts are divided whether growth stocks are set to make a comeback, based on this future rate hikes. But Alphabet is a pure advertising play, and you probably want to own something exposed to an advertising market over time. So this is an example of a stock that gets sold off with the stock market. If the stock market goes down another 10 or 20%, you'll see Google go down 15 or 30%. So we're keeping our eyes on those estimates just to make sure there's nothing changing, for the analysts' eyes. Okay, that was one of them. Let's look at
Actually, quick question.
Yes.
Do you see that we are in the bottom yet?
Oh, it's like it's a fool's errand to try to call a bottom in this kind of environment. We have like liquidity being pulled from the stock market, the United States economy, and we have a downtrending. We have a downtrending lines, that we're following, and they've been really consistent, and they haven't even peaked out of them yet. So I'm thinking until we have either major earnings, we have the economy, until we have any of these major catalysts in our meeting notes happen right here. We need some of these to happen for us to get out of this downward trending, lower highs, lower lows. And right now, it seems like the path of least resistance is just keeping these lower lows and lower highs. So it's almost impossible, for anyone to predict that.
The reason I asked that because similar experts also put Amazon and Google together as a hot stock, and then the next day, all of your hot stock tumble like 5 or 10%. I mean, a couple of percentage down. So it's not hot after that.
Yeah. But if you're looking for a growth part of your portfolio, almost every one of these stocks we're following kind of follows this lower highs, lower lows. Let's say right here. Let's say we get to let's look at Microsoft. If you're interested in Microsoft, we see that there's you know, times whenever the stock is down, like right now, it's hitting at the bottom of the range. So if you put a little bit in here, and we know that there's a possibility of it going up to here and going back down to here, then you put a little more down to here. That's how you kind of dollar cost because you never know when we're going to go back up. You never know when the stock market bottoms and we hit that COVID low. For me, I'm holding, and I know, that over time Google's going to return 8% every year, or 8 to 12%, and as long as those estimates, are consistent and their product is the same, and when we get out of the recession, that's why we're looking at this. When are we going to pull out of the recession? It seems like they're going to be done hiking their rates right around February, and the stock market will probably start recovering around April or so. It's hard to say. What do you think?
They didn't say that they will pause their rate hiking, right? They say they will slow it down with a smaller rate. They never said that they will pause or stop.
Right. So we have to basically guess at when they're going to stop. And right now, the 2-year is saying that 4.7 is the target, right? So that kind of bakes in the 50 here and maybe a 25 here, and then we'll pretty much try to go back to normal around April or May. So the hard part right now is that statement the Fed said we're not even close to being neutral, and stopping the raising rates. So that means the whole January and February are kind of possibly negative,
Yeah.
Yeah, and so what I was going to say is that for these stocks, then trying to time it and pick the bottom and top is not really possible. You can get lucky, but if you can find a company that is a good valuation and that you think will be growing, and especially for its earnings based on its current price, then that's when you want to buy in, right? That because some of these, when it does turn around, they could move up very fast. And if you're like, oh, I want to be in that, I want to own, Google or something. If you wait until they start going up to buy them, it might be a bit late. You're going to miss out on a lot of that upward movement.
That's true. Yeah.
Yeah. So they say if you miss the top 5 days in the stock market over 10 years, that's like half your return. So that's why it's important, and you can't get like sucked into these rallies. Oh, it's going up. How we had the fear greed index, greed, last week, because we went up like 20% in 2 weeks, but we're only up to this top of this channel. So you have to make sure you don't get sucked into it where we're out of this, and then we just go back down. But you have to keep in mind that we're getting, as the stock market goes down, we're getting cheaper and cheaper valuations if the earnings continue to let me look at something here. Hold on. Okay, if the earnings continue to perform like they have in the past, that's why you have these 10-year earnings charts, and look at the PEs for the last 10 years, what they've traded for, knowing what they're trading for now. If Google goes down to 5 PE, this is actually Hershey's. This is a different stock. But if Google goes down to 5 PE, that's like half of what they've traded for, or 1/3 in the past. So then you'd be getting them, a better bargain as it goes down. So that's kind of the big picture, I think. Any comments around that? Right. All right. So price of oil isn't really going anywhere right now. It's pretty much out of our control with OPEC manipulating the price of oil, and a lot of different manufacturers making oil around the world. We never know what the price is going to be. So we know that the lower the price of oil, the better the economy is because it costs less to make products. You see, and you see, in the 10-year Treasury, we already mentioned it's up. That's really bad for the stock market. That was probably due to that Fed statement, the raising. We're not close to being finished raising rates, and it'll be happening longer than expected. So a dollar index isn't changing at all. It's still around the same. And so is it a major variables. Let's look at what's happening in the sectors today. Okay, let's see. One's doing the worst. Telecom, retail, biotech, healthcare. Wow, that's like flipping things around. These are the ones that were doing the best for the past month or so. Not the retail, but the biotech, consumer discretionary. These are all very conservative sectors that have paid dividends. And the ones doing the best today are gold miners, metals, materials, oil, financial, energy. Let me see. Okay, so that's interesting. I don't know anything about why the metals are going up. Could be.
They've been down so much.
The what?
They've been down. So.
Oh, they've been down a
Also,
lot.
they-
Now
yeah.
they're recovering. This goes
What
back to
what
our
come up have to come down.
Yeah, that goes back to our talk in December of last year. I don't know if you remember, we were kind of planning the year ahead, and we were talking about reversion to the mean and how every sector reverts to the mean. Every stock, every index. If S&P has traded at 15 PE for the history of the S&P on average, and we're up at 28, we eventually revert to the mean of 15. And same thing with the stocks. If the stock has traded at a PE of 30 its entire life as a company, and now it trades at a PE of 5, that's a very good indication that the PE will eventually go higher. All right, so that was interesting. I'm glad we did that little task. All right, so the stock market, this is the S&P 500. We can see that we did hit this top of the trading range. And our channel right now is like perfect for the whole year. And it looks like we're going back down to the bottom of the channel. We don't know what, one of those pieces of news that we're waiting for could happen, and it could break us out of this. When that happens, then we have to start planning something totally different for every stock and our way of approaching this environment. Until then, we just have to be willing to go through lower lows and lower highs until we're out of this. Okay, so right now we were agreed last week. I think we're agreed today still. It just went from neutral to agreed when we were watching here. Is it? We're agreed right now. Okay, so we were agreed 60 last week. So we see that the as the stock market goes up towards this high, and we went up like 20% in a short amount, 10% in a short amount of time, and people get excited. And it's just that opposite time when it's not the time to buy. So right now people are still pretty excited about getting out of this and having the end of this rate hikes and inflation. All right, so let's look at the VIX. This is pretty interesting. It's down to 25. That's been like an average for the past year or so. So this is like people are pretty complacent right now, and it's basically a contrary indicator that once it goes down to 25, it's time to start selling, and then when it gets up to 35, it's time to start buying. So we're still kind of complacent right now, and people aren't really doing a whole lot of protection in the options market. All right, so the big news for this week is the Fed hikes interest rates 75 basis points, and it's very premature to talk about a pause. That is the statement. As soon as he said that, the stock market went down like 3%. So the translation, the Fed could step down the slower pace in December, meaning it was 75 this time. A slower pace means it's maybe 50 point next time. And the second thing is there is no the terminal funds rate is whenever the stock they stop raising, and that's around 5%. He's not ready to talk about a pause, and that just really made our whole calendar change to yellow from possibly green, because everyone's waiting for them to be done with this interest rate hiking. All right, so today there was a jobs report. The payrolls grew by 261. That's better than estimates. So that means the stronger the job market, the more the Fed will have to raise rates to make things a little less frothy in the job market. So let's review the Fed mandate. This used to be a meeting about stocks, and now it's turned into like analyzing the Fed and interest rates and stuff. So, well, that's just what we're finding. The stock market follows interest rates. So that's why it's important to learn all this. The Fed's mandate is maximum employment, stable prices, and moderate interest rates over time. And there's a 2% target. So maximum employment, we have to always watch the job report, and if the wages increase too much, then that means the economy starts growing, and so we have to try. The Fed is trying, by raising interest rates, trying to reduce the wage inflation too. So, all right. So here's a news story about Qualcomm. Qualcomm is the major supplier to Apple for modems, I think. So they're showing some weakness in demand. And as soon as that story hit, Apple went down. And there's a rapid deterioration in demand across the semiconductor industry. So we have already had a lot of stories about the semiconductors, being having too much inventory. And so the lesson learned with this, we were looking at Qualcomm last week as a possible stock to look at. I mean, as a potential quality stock to invest in. And the problem with Qualcomm at the time is, for the past at least 10 years, they've had problems collecting royalties in China for their 5G, 4G, 3G technologies. So their earnings have been inconsistent. And then Apple started playing games with whether they wanted Qualcomm chips in their phones. So that made their earnings less predictable. And now they have this, this warning about earnings. So that makes it a lot more unpredictable. But the lessons learned, every time a supplier to a major, one of our watch list warns, we have to say, well, that could affect Apple, because if they see a softness in this smartphone industry, that could affect Apple. But like I mentioned earlier, Apple has a lot of suppliers, so they could easily get a different modem supplier, and even though they're seeing a lack of demand, that could be because Apple got a better deal somewhere else. Okay, so their earnings are not consistent, and that means people won't pay a premium for the stock. So the good thing about companies like Apple is they have consistent residual income, and that makes the earnings a little bit more reliable. So the chip shortage led to overcapacity, and that led to lower profits because they have to get rid of their inventory now. And that's a theme for a lot of companies recently. All right. Okay, we're keeping our eyes on this whenever the Fed reduces their balance sheet, and where they're still in the process of reducing their balance sheet, the stock market basically follows. And sometime maybe July of next year, we'll be in a place where it's stable. We're not raising. Maybe at the end of next year, we'll be reducing interest rates. So when that happens, we'll be ready, and we'll know that as the Fed is accommodative, we'll have a better performance in the stock market. All right, so right now I think we're looking at this investor emotions. Seems like everyone's greedy right now. Like, oh, we had the dip, everyone was scared. There was extreme fear. Now we're kind of recovering. We're back up to maybe a point of stability in the stock market. We might be out of this right here. Just when that happens, people will be scared and we'll go down to a new low. So you have to keep your emotions in check and know that we're still in a trend going downwards right now until we break out of that. All right. So looking at the big picture of the average stock market returns, we're going into the best time of the year. Right now, you can't get any better than the last 3 quarters of the year. But we haven't been through a rate reduction, for at least 10 years. So, I mean, we haven't been through a rate hike cycle at the end of the year for a long time. So that could definitely, these end of the year great returns may not happen this year, just because of this Fed statement that they're going to be raising rates longer than expected. We don't know, but looking at our calendar, let's look at our calendar. At least we can count on a Christmas rally and the end of year rally and possibly a Thanksgiving rally. So, and then we have end of year window dressing, and I didn't put that on here, but that's also something in December. End of quarter, end of year window dressing. They could make the stock market go up in the last 2 weeks or so. All right. Any questions? Anything that you wanted to go over? Any topics? All right. What we'll do is we'll go through the market movers for today, all the stocks that are going up and down. We can see we pointed out a while ago about how Starbucks, let's look at Starbucks. Starbucks is one of the only stocks that we're following that's in an uptrend right now. We said, the rationale for this company in this environment is coffee is an affordable luxury. Even when there's a recession, people will spend $8 for a latte because it makes them feel better and they can afford it. So Starbucks actually just had good earnings. So that's why they're up today. And let me see. Stocks going down the most. We see Chinese stocks are going up. There's like an on and off. Is there going to be a COVID change in stance from the Chinese government? One day they said they're going to, be a little softer on their COVID, allowing people to get around, and every day it's a little different. And these stocks that are China stocks are going with that, up and down. So it's pretty unreliable, the Chinese stocks. We see a lot of semiconductor stocks, Lam Research, ASML Holdings, Skyworks. They make modems and devices for the iPhone. Okay, Baidu, JD, and those are 2 big China stocks. Let's look at what's declining the most. I have no idea why Atlassian, they're the maker of Jira. We use them, and they're down a lot. They're a small company. Okay, so we see a lot of the major antivirus companies going down. CrowdStrike, Zscaler. The major theme in all of these companies is that they're very high PE ratios. That follows our theme that the stocks doing the worst in this environment are ones that have a high PE ratio that are overvalued. And right now, DocuSign, that's like the poster child for, we've been following that for a long time now. It's still super overvalued. Datadog, Workday, all the antivirus companies like CrowdStrike, Zscaler, they're super pricey, but they're growing fast. And they have a stable product that is going to be needed around the world. And companies, you can't be cheap with your antivirus because you need that. So that's why there's a steady demand for their product. But in an environment where people pay for earnings today and not tomorrow, these kind of stocks with the high PE ratio go down first. That's it. Yep, every one of those stocks have high PE ratios. Okay, let's look at more of what the S&P is doing. I don't see any patterns here, really. I guess the Freeport McMoran, a lot of the materials sectors were up, such as gold and silver. So Freeport is one of the bigger makers of copper and gold, and you'd see Newmont Mining as a gold. So a lot of these in the top 10 are material companies that mine. And the ones doing the worst, okay, you have solar companies like Enphase, SolarEdge, and also, see.
Why PayPal go down?
Why PayPal? Oh, they have bad earnings. Let's look at PayPal, just because we followed this stock before. I remember it was recommended. We had this PYPL. They have bad earnings, and let's look at their news today. Statistics. Let's look at how overvalued or undervalued this stock is. It's still, the PEG ratio is 1.57. So based on what Yahoo says, its PE is 18. They're probably growing at 10. So if you divide 18 divided by 1.57. Okay, so it's probably growing at 11% a year, and so it's overvalued, and they missed their earnings. So one good thing about PayPal is when interest rates go up, they make more money on their balances. There's a lot of people that have a PayPal balance. They don't get paid for it, just money, cash, sitting in their PayPal account, but they can actually make money as interest rates go up. So that's one good thing about PayPal in this environment. But it's still overvalued, and it's not growing. Let's look at the estimates for PayPal just for fun. Okay. Okay, so let's look at its earnings estimate. I'm thinking it's grown 11%. We'll do our calculations here. Okay, so 4.01 divided by 4.79, that's around 14%. 4.79 divided by 5.67, that's 15%. 5.67 divided by 6.26, 10%. Okay, it's like a 12% average over the next 5 years, 13%. Okay, so if it's trading at 17, so it's still, that kind of matches the maybe 1.4 or 1.5 peg ratio. So it's still overvalued, but that growth is going down. It used to be growing at like 30%. The pandemic helped them out a lot because people were buying things online, but now that people are not, they don't have that tailwind anymore. So they're, I think another big problem with PayPal is eBay is making their own system and they're getting away from PayPal. So that was a consistent source of revenue for PayPal, but now it's still overvalued. Does that help any? Okay, so I think that, let's look at their earnings, their news summary. It'll give us some idea of what the news says on them. It says, has pivoted to more of a mature model. Okay, so they're being less aggressive with what they're doing. So they're not going to grow as much if they have a mature model. Let's see why PayPal moved after hours. It'll give us a one sentence summary here. That's amazing. It didn't really have, they had earnings. Let me see. Net revenue top, adjusted EPS coming in better than expected. Total payment volume missed. Maybe that was important. The payment volume for Visa and MasterCard are steady, and American Express. So this is a company-specific thing, it seems. Another big headline, I guess if they give bad guidance, that's another thing that would cause the stock to go down. So it looks like there's a resumption of the sell-off in some of the big cap tech stocks again. So it looks like this week there's kind of a move from the big tech stocks to the more conservative Dow-oriented stocks. So let me see. All right, so let's look at what other things I had prepared here. Hold on for a second. It'll just be, okay. Okay, so this week we had like a red screen for a lot of the big tech stocks, and that's kind of continuing today. But we don't know when that's going to turn. Whenever there's going to be buying pressure on these stocks, most likely that major move for the tech stocks will happen after interest rate scenario is finalized and we know how much is going to be raised, and they give some indications for that. But eventually there's going to be a turn, and it'll go up 10% in 2 days. But right now, until further notice, these stocks are in a downward trend. Let's look at the other thing I had prepared here. Okay, one thing that happened recently, Ford, they closed down a self-driving unit. That's 1/3 of Waymo's competition. So Waymo has GM as a competitor, and Cruise, and there's a couple other smaller competitors. So, but after, this is Morningstar's take on Alphabet. They said their fair value is 160, and they're hurt by the strong dollar, and advertising revenue should return to double digits in 2023. And cloud is still impressive growth. But in an environment where every stock is sold, when the stock market's going down, stocks can get really, below their fair value. So you just have to keep in mind and keep watching these fair values and notes from these companies to see, if there's something major wrong. If there's a really big recession, perhaps the companies spend less on advertising. So that could hurt every one of the big companies. But one other thing is the Morningstar expects one of the moonshots to material contribute to Google by 2026, such as Waymo or some of their other side projects. So I'm noting almost every one of these tech stocks is hitting their bottoms. But if they go below that, if we see some of these tech stocks go below this trend line, then who knows where we've lost our trading pattern. We got to find some other pattern to follow. You see, every one of the big tech stocks is pretty much at the bottom of its channel. Let's hope it doesn't go down below that, because if it does, then we're in like a super sell-off. But the stock's doing really good now. Continue to be Pepsi. It's pretty much at the top of its range. It's at an all-time high and overbought. Let me see. You already mentioned
Is your
this.
portfolio holding Amazon?
Say it again.
Is your portfolio holding Amazon?
Yes, but what I did earlier this year is we were talking about how all the stocks with the high PE ratios are going to get hit the most. The ones that are overvalued, that have the PEG ratios of 5. What I did was I sold 2/3 of my Amazon to get down to like a 1/3 position, because this is like way at the beginning of the year, because I wanted to move towards stocks with a lower PE ratio that have a dividend. So I sold 2/3 of my position just because of that PE ratio problem. And they have a history of selling at a premium, and now there's reasons why that there's a slowdown in their cloud. There's a slowdown in their possibly selling things online. So in a recession, that would affect all around business spending and consumer spending. So that's why, but I do have like 1/3 of what I used to have. Right, and let's see. Oh, one last, there was an article that Hershey had really good earnings. And I said, well, it's interesting. Let's do a little look at Hershey's. Hershey's is a company that's, it's kind of like a weird corporate structure. They have like a trust that decides whether or not the company can be sold, and it makes decisions for the company. And I don't really understand it a whole lot. So that's one interesting weird thing. It's not like a shareholder can vote on things. But all that being said, it's in an uptrend. It's another example of an affordable luxury chocolate. When you're sick of the economy, whatever, you want to grab a chocolate bar. So their third quarter sales rose 13%, but they've traditionally sold at a very high premium. They're still 4 times, their PEG ratio is 4. Their forward PE is 27. I looked at their growth, it's only at 5%, maybe 6%. So they're 4.5 times overvalued if you look at their earnings growth, but it's pretty consistent, 6% growth. So I compare this to like Starbucks. It's an affordable luxury. In a recession, people still buy their chocolate, and they have pricing power too. And they have one problem is if they have any kind of hiccup in their estimates, or they're missing earnings, their stock will drop a lot. So that's what happens when you have a PEG ratio of greater than 1. But that's, and CFRA says 2 sell ratings. They said it's overvalued, it's 30% overvalued. and they have higher manufacturing costs, equipment scarcity, and ingredient scarcity. I think palm oil is becoming harder to get, and but they have strong pricing power, and they can push their higher prices on the consumer. So I think I ran out of time. I think that's about all. Yeah, this right here is they're just not growing that much, but they're growing pretty steadily. But their PE ratio has been pretty high over the history of the company, and right now it's kind of in line with that. So it's not a very exciting stock for me, but if it dropped in half, I'd look at it again. The other thing I wanted to say is that there's a black swan alert of the week. This happens every week. Okay. So a major hedge fund warned that the hyperinflation that we're could experience in the future could lead to global societal collapse. And this could be another thing that could cause, a super crash of the stock market if we have pullback by economies around the world and we have super recessions. But let's hope it doesn't get to that. Civil or international strife, I don't know.